Good afternoon, everyone, and welcome to this exclusive webinar for premium banking clients organized by Standard Chartered Bank. At the onset, on behalf of the bank, I would like to thank you all for joining in this webinar and look forward to your active participation. Today, the topic for discussion is systematic investment plans, or popularly known as SIPs. Through this webinar, we aim you to demystify SIPs, share the many benefits of SIPs as well as of early investing, and help you gain more insights on how this is an effective tool for growing your wealth. And who better than Mr. Karan Datta, who joins us for this webinar to explain the importance of SIPs. Karan Datta is the Chief Business Officer of Axis Mutual Fund. Karan is a postgraduate in management with over 24 years of experience in sales and distribution of financial products. His previous experience includes Goldman Sachs AMC, Franklin Templeton AMC, and Birla Sun Life. In his current role, Karan looks after sales and distribution, digital initiatives, marketing, and investor services for Axis Mutual Fund. Thank you, Karan, for joining us, and over to you.
Thank you very much. Good afternoon, everyone, and a pleasure being here on behalf of Standard Chartered, and greetings from Axis Mutual Fund as well. First of all, congratulations on choosing a really, really important subject, which is the world of SIPs. I remember 18, 20 years ago, when I was first introduced to the concept of SIPs, it sounded very alien to me. It just sounded as if, how can you create wealth if you invest a very small amount of money and you do that consistently? It just, intuitively, it just didn't make sense to me, because mathematically it really had to become very powerful. And I must share with all of you on this call or on this webinar that the first thing that I want to share with all of you is that over decades, wealth creation is imminent. And what I will do is probably step aside for a while and not talk about SIPs to begin with and equities, but actually just get into your world, which is the world of the consumer, the world of the investor, and actually start with the fundamental question: why invest in the first place? Why do the SIP in the first place? Why even think of investing? And it all comes down to the one single fact that the investment is virtually every time linked to some goal or the other. And you can think of yourself as planning for your retirement, planning for your children's education, planning for a house, planning for a car, any one of those reasons. And in my own personal experience, one of the things I've realized is, as long as there is some reason to invest and some reason to allocate money for a goal, it always pans out, because the intent out here is to look at why are you investing and then find the right solution. SIPs happens to be the right solution, but the reason for the investment has to be a reason that is very personal to you. And I will again step back into my life and give you an example of what I'm trying to say out here. Roughly about in 2008, I just want to give an example of 2008. That's the time of the financial crisis. At the time of the financial crisis, I have had friends who used to invest in mutual funds and used to just invest in SIPs. And they just continued doing so without even having a reason to do so. As the financial crisis came, few of my friends actually lost their jobs. And it was a very tough phase for them. Within that set of friends that I had, two of them were doing SIPs because they were planning for their retirement, they were planning for their children's education. Those two friends of mine, even when they lost their jobs, never ever stopped their SIPs, because there was always a reason to invest. But there are a couple of other friends of mine who just stopped their SIPs because they just didn't know why they were investing in the first place. So the background that I'm suggesting to everyone on this call and on this recording is that please speak to your advisors, speak to your advisors. Please do have this conversation with the teams back at Standard Chartered as to why are you investing in the first place. Once that clarity comes through, the rules, the the roadmap and the asset allocation and the fact that you can choose SIPs then becomes a very, very relevant via media to reach your goals. I now want to delve into what is happening in this country and as to why I think or why we collectively think SIPs is a really, really formidable way to create wealth. First of all, I want to tell you the fact that SIP, the word SIP is really quickly replacing the word RD. So as generationally, we've all grown up, at least as far as my father's concerned or the generation before me, has all been taught about the word RD and FD. So recurring deposit and fixed deposits. But if you see what is happening in the last 5 or 7 years in this country, suddenly the word SIP is assuming a lot of meaning and it's assuming a lot of importance as well. And it's almost turning into a crusade. Why is that so? It's simply because of the fact that systematic investment planning is your route to investing in capital markets without taking disproportionate risks. And that is the fundamental premise on why SIPs are becoming so prominent. A small amount of money, depending on your capacity and capability to invest, gets allocated to equity markets or for that matter in fixed income markets monthly, bi-monthly, sometimes even weekly, and in some cases even daily. What that really does, it cuts down the ability to take market-related risks. Hence, what you're really doing is not investing at one shot, but taking that same amount and investing it in smaller proportions on days that you think are correct. For example, if the salary comes in on the 7th, you actually start investing on the 7th, and so on and so forth. Two things happen. A, it actually cuts down the risks of entering the markets, and B, the amounts are reasonably allocated such that they take into account your own liquidity. Both these factors put together allow an investor to take access or get access to capital markets. And by capital markets here, in a sense, what I'm talking about is equities. Now, the fundamental question that I ask everyone, are you here to make money or are you here to create wealth? Because there's a massive difference between the two. If you are here to create wealth, wealth creation will only happen over decades. And I'm not trying to dissuade you by letting you know that decades is the only way out, but India is a country of decadal wealth creation. And perhaps the best way to do that is to take a decadal view and make sure that you stay committed to the route of SIPs, of investing monthly onto that decadal journey. And the reason why I say that is because there are funds and schemes that Standard Chartered would have also looked at over time, and there are schemes and funds that have delivered 20% CAGR over 20 years. That is serious wealth creation. That basically means money has grown 80, 90 times. And participating in those kind of funds and schemes over 20 years has resulted in tremendous amount of wealth creation. The only place where I think that there has been a bit of a disconnect is that funds and schemes have delivered the 20% CAGR, but very few investors have participated in it, because most of the times the investors tend to look at what's happening in brackets of 2 and 3 and 4 years, rather than looking at it as 10, 15 and 20 years. So two messages that I have core out here. One, please step back, have a look at why are you investing in the first place, what is driving you to invest. Please reach out to advisors within the Standard Chartered system. They will be more than happy to understand your goals and your asset allocation needs. Once that is done, capital markets through the SIP route becomes a wealth creation solution, and that access to capital markets through the SIP route definitely results in some wealth creation opportunities, especially in a country like India, where actually, if you look at it, we've been delivering. Markets have delivered over 10 and 15 and 20 years, in spite of all the problems that we tend to see as a country, whether political problems, whether economic problems. We always tend to find 35 to 40 companies that create solid wealth. That's our job as fund managers. Our job as fund managers is to look for those 40 companies that create wealth And the job of Standard Chartered and as investors is for you all to stay committed on that journey and hence get the benefits of what capital markets have to offer. I can go on and go on talking about SIPs, but I just kind of give you my own personal example. 20 years ago, I started investing in SIPs. The amounts then and the amounts now are very, very different. I started off with a very small amount. Today, those amounts have become larger. Obviously, over time, as my salary has grown and as my ability to invest has grown, my SIP has also increased. But what has happened is the SIP that I started 20 years ago, and if I would start an SIP now, there's a world of difference. So 20 years ago, I was, 25? My SIP at the age of 25 has actually created more wealth or, has generated more money for me than if I was to start today. It's just the power of compounding and the power of starting early. So for all friends and for all those who are on this call and for those who will be watching this video, my sincere advice is, if you really want to do this and do it right, start early. As is the case with virtually everything in life. You can start early, you can start with the amount you want to, but each year started earlier actually has a profound effect because of the power of compounding. So it's really been said that there are 7 wonders in the world. Compounding is the 8th wonder, and it really works in SIPs. The other thing that I just want to leave all of you behind with is the opportunity that this country actually offers as far as wealth creation is concerned. You've obviously heard all of this, young population, perhaps the fastest growing economy in the world, etc., which is all very true. One thing that tends to be missed out is that as a country, we're very fortunate to have access to over 30 sectors to invest in. All of that makes this a brilliant proposition. Step back, look at the reasons why you want to invest, reach out to your advisors in StanChart and start looking at SIPs. I think I just kind of sum it up in that format. In case there are questions or in case there is any deliberations, you may have a question for me.
Yeah.
I'm happy to.
Yeah, thanks, Karan, for a quick update. And we are getting a lot of questions. Just before we dive into the questions here, what do you think is an ideal tenure for an SIP? Because should the tenure be linked to your goal planning or investment horizon, or is there any data suggesting that how there's a typical tenure beyond which then the SIPs start bearing more fruit?
So that's the most fundamental question. What is the ideal tenure for an SIP? And again, I would just go back to everything it's all very personal. And let's just take the example of someone who is starting an SIP at 35 and perhaps wants to retire at 50.
Yes.
So what he's really trying to do is build a retirement corpus. So from 35 to 50, it's 15 years.
Yeah.
For that person, the ideal tenure for the SIP is 15 years. But flip it around. If the person is 35 and he does want to have a goal which is 5 years down the line, at age 40, perhaps a house or some other goal, the tenure becomes 5 years. And so again, what will happen is when as an investor, if I was to come to you and say that there are ideally either it's 5 years or 15 years, you would then come back and give me your suggestions accordingly.
Sure.
But for that, you must know
what's
my reason for investing. I just want to make one point here. If it was not about goals, if it was simply about investing, then I would like to define what is short-term, medium-term, and long-term. In a country like India, and the fact that if you're here to create wealth, the definition of short-term is 5 to 7 years. Medium-term is 7 to 12 years, and long-term is 12 to 18 years. If you have those kind of horizons, you are going to make money.
Thank you. Another question is, if we start monthly lump sum investment on a definite date instead of SIP, will it be the same process, or would it be better to do an SIP?
Well, it sounds almost like an SIP. So if you were investing monthly, whether it's lump sum or the lump sum then becomes, it is an SIP, right? Really, technically there is no difference.
Okay.
because what you're doing is you're taking an amount and investing it on a monthly basis. So let me just clarify this. An SIP is not necessarily a small amount. I'm sure you all have had clients and investors who've actually done 40, 50 lakhs per month. I've encountered investors who've taken 50 lakhs per month, have been investing that per month. So please don't go by the amount out here. The process is the same. The reason for investing monthly is to stagger the investments and hence not get caught by what is known as market volatility.
Also, a lot of SIPs which we see is mainly invested in equity-related funds. Does SIP in like sectoral or thematic funds, or doing SIPs mainly in liquid and debt funds, does that also be a prudent? Is it same? Like, can we use that as like how you do a recurring deposit, which you mentioned earlier?
Right.
Where we used to do is in debt funds also, can we do SIP as is prudent?
So yes, but if you allow me a little bit of a deviation on the answer, it's actually a very relevant question, and the answer I'm going to try and give right now is also relevant given the new set of regulations around taxation. So if you were to build a monthly way of, let's say, a payout to yourself, then what I'd really recommend is go for systematic withdrawal plans. And that's the way to kind of build the purpose of having a monthly amount coming into your account. Having said that, I'll answer the first question, which is, does it make sense to do SIPs in bonds and asset allocation funds? Absolutely, yes. It does make sense, especially in these asset allocation funds, because there again, the intent is to stagger the investments and hence ride out the volatility that markets may offer. And the same is also true for bond funds, because it's any access, any form of investing in any form of markets is subject to risks, and you kind of ride through the risks by investing on a periodic basis rather than through one time. So whether you're in equities or bonds or asset allocation funds, it always makes sense to stagger those investments.
Thanks. So you mentioned on the one of the biggest advantages of SIP is the compounding effect which is there. So there's a question on that, how compounding is applicable. As we invest a certain amount every month, we get units for that. Then how does the compounding actually work? So I think the question basically is they want to know exactly how is the compounding.
Yeah.
So if you put 5,000
Right.
in every month for
Right.
a specific amount of time, and after 10 years you invest that amount, how much does the compounding impact come in? So suppose after 5 years, what would be this relative value of the product?
So right at the start, I gave you the live example of markets and funds. And I'm not taking a 5-year example. Now I'm taking a 20-year example. Over 20 years, schemes and funds have delivered 20% compounded year on year. And again, just mathematically, that's whatever you invested, whether it was 1 lakh or 10 lakhs, then that grew by almost 85 times over those 20 years. And I tried looking at some other options over the 20 years. Was there any other asset class that delivered 20% CAGR? I really didn't come across many assets that have. In fact, I couldn't come across anything that's delivered 20% CAGR. Maybe bits and pieces of real estate here and there, but 20% CAGR has been delivered by at least 3 or 4 different asset management companies' schemes. Now that's the power of compounding. Now how does that work? So if you look at it mathematically, what are we trying to say out here? What we're saying is equity is never going to be linear, right? It's not APGP, it's not arithmetic progression and geometric progression that you invest and you're bound to get a certain amount per month. No, it never works like that. What will happen is equities over 5 years or 7 years could be first year 0, 0, 0, 0, and then the 5th year it could be 100% return. And that's how equities deliver. Now, how do you tide over that? Because what you're really trying to do is take advantage of markets at any given point in time. And hence, in a down market, you're actually getting more units. And in the up market, while you're not getting more units, but your existing units are actually making money. And that's how you tide over this entire phase. So let me rephrase this. What if, which kind of market do you want? You want 0, 0, 0, 0, 100, or you want 10, 10, 10, 10, 10 every year? And you'll notice the difference is that in equities, it's never ever linear. And so the only way to pass through this non-linearity is to kind of take exposures at every point in time.
So one question is from a client who says for like children, if you have young kids, and what will be the best combination of SIP, especially if the goal is for education? So the time horizon usually will be 15 years plus.
Right.
So is it so you keep doing SIPs in equity related funds?
Yeah. So again, I mean, see, the best way for me to answer this is to give you again my personal experience around this. My daughter is now 16 and she will now be going abroad to study. I've been investing on her behalf for the last 10 years, and it is 100% SIP in equities. That corpus was estimated at a certain rate given the cost of education, etc. At that time, I kind of looked at what the cost of education could be in the year 2020, and then went back, took a number, and just did SIPs in equities, because that was two reasons. One, I had a 10 to 15 year time frame, and because there was a 10 to 15 year time frame, there have been funds that have delivered that kind of there are funds that have delivered that kind of returns. And more importantly, I had the capability to take that risk, that even if it was a volatile journey, at the end of the 15th year or the end of the 12th year, there would be a corpus available for my daughter's education. So if the education goal is 10 and 12 years away, I would always recommend equity exposure. But if it is anything around the 5 and 7 year mark, I would always recommend asset allocation funds where there is part equity and part fixed income, because as the goal is nearer, you won't want to take too many risks with the corpus itself.
So one question is on the long-term capital gains tax with that coming in, and how do you see it affect the returns in long terms? And if we invest in long-term equities, should we try to use it through the SIP route? Is there some implication from that, or we just have to take a little lower return expectation?
Yeah, so there's a lot that has been said on long-term capital gains. So much has been, we've read so much about it in the papers. It's so much commentary around it. And honestly, I really believe that, equities were never about 1 year. It never was about 2 years. There's a fundamental disconnect that we look at everything from a taxation point of view, and we miss out on the wealth creation capability of this asset class. Again, I mean, over 10 and 20 years, if you were to get an asset which delivers those kind of returns, where in the past money has grown disproportionately well, then the LTCG becomes a very insignificant part of the entire expense structure. Having said that, yes, it's got introduced, and yes, there are ways to go to look at via medias. And one of the via medias I suggested was a systematic withdrawal plan, which is your existing corpus, you can allocate a certain redemption value through the systematic withdrawal plan, and that's a very tax efficient way to take your money off the table as well. So again, if you go back to your advisors back at StanChart and to the relationship managers and talk to them about SWP, you will get the benefit of a very tax efficient way of withdrawing your money. It's almost akin to a dividend payout, but it's far more efficient. And I would actually always recommend the SWP over a dividend payout.
So there's a question from a client. He said he's very new to SIPs. So how do you decide on the rate of return that you need over investment, and the time horizon? How do we come about that question?
Okay. And what's the name of the gentleman? Yeah. Okay. So first of all, for the gentleman who's asking the question that you're new to the world of SIPs, welcome to the world of SIPs. and I hope and pray that you have a lovely journey in the tenure that you're going to be investing. So in the world of mutual funds, we never ever give a number out because remember, these are all subject to how the markets perform. And I would always go back to past track records. And again, there are schemes that have delivered some fabulous numbers in the past. A reasonable expectation, and we don't generally speak about numbers, but a reasonable expectation to expect from equities is anything upwards between the 11 to 14% per annum. But like I said, this is not linear. This is at a compounded effect that if you make that kind of money over time, that compounds to a very large number at the end of the tenure. But leave all this for a minute and please ask yourself, why are you investing? For the person who just invested for the first time, if you're here for a goal, if you're here for a reason, if you're here for getting a certain dream fulfilled, just look at the tenure and then ask the advisors at StanChart how to reach that particular goal. And they will give you a set of perhaps 2 or 3 funds which, given their track record, would be closest and most efficient to reach to your destination. So if I was to give you a number, ideally equities 400 basis points over what nominal GDP is, and without getting too technical, let's assume anything between 11 to 14% is what we should ideally expect equities to deliver over longer frames of over longer frames of time. Yet funds have actually delivered 18 and 20%. So that's what equities can do. But remember, in my definition, medium term is 10 years and long term is 15. So you've got to keep that in the front of your mind as well.
Another question is, what do you think of the different SIP variants that are in market? Some of them, they link their monthly installments to market indices or portfolio performance. Are they good way of investing through SIPs, or do we stick to the asset allocation type of model where we take some bit of according to where we want and our goal is there?
So yes, there is, I think the question that you're asking me is about value SIPs and value indexing. So let's just come to the fundamental fact that SIP in its purest, simplest way virtually works 80% of the time. And you look at your smartphone and you look at most of the features that you end up using. 80% of the time you end up using it for either phone calls, messages, and social media, even though it has maybe 95 more features. But primarily you're using it for 3 or 4 things. And the same is the case for SIPs. Yes, there are very smart variants, but I would always recommend the most basic format, which is monthly investing. But the tough part is that monthly investing over 10-year periods. I think that's the one that really makes money and not necessarily the variance. As long as we get the holding period right, that's really going to be the crux of the matter and not necessarily the construct of the SIP.
So this question is a little, so in the past few days there's been news of mutual fund growth becoming less than what it used to be. So looking at this current scenario, what would you consider as an upcoming investment tool? Is SIPs the best way as mutual fund, given that returns for long term?
Oh yeah. Look, there is. Even if I was not in the world of mutual funds, even if I was not representing a mutual fund company, I can share this with you. What are the options? Let's just look at what the options are. Real estate, yes, great option, but is it a liquid option? Perhaps not. Is it something that can you go back to your real estate agent and say, yes, I want to sell my property in less than 5 days? No, it does not work that way. Gold in this country has been overdone. We all know that gold as an asset class has been overdone. For generations, gold has been held. Fixed deposits, given the fact that inflation and fixed deposit rates have virtually been the same, it really never has added well. Even at the highest peak, at the peak of fixed deposit rates at like 13 and 14%. Actually, inflation was at 15 and 16. So deposits were being eaten up by inflation. And that really leaves Indians not taking the benefit of capital markets, and which is what makes our journey through the SIP route into capital markets most critical at a time when households just don't have any exposure to equities. And look at some of the names that we have on offer in India, from paint companies to auto ancillary companies to auto manufacturers to banking companies to pharmaceuticals to IT. I mean, there is just, like I said, there are over 30 sectors to invest in. And I'm absolutely sure about it that wealth creation versus making money, there's a world of difference. And if you get the time horizon right, you will create wealth. And I'm not really necessarily worried about the slowdown in the mutual fund space, because it's just a reflection of this volatility and the fact that markets have just come down a little bit. But like I said, this line of exposure and this line of investing is best suited for investors to create decadal wealth.
So given that this question came and there is market volatility there, so there's another question: is it good to invest right now in lump sum whenever the market is down, or should we stick to the discipline and do SIPs, which is a better way?
Yeah, so that's a good question, because so two things. One, so I would actually always go for the route of the SIP for simple reason, because see, there are risks being taken while investing into capital markets. Why do you want to compound that risk by taking a call there and then? So if you have the money and if you know why you're investing and the horizons are clear and you're willing to ride the volatility, willing to accept the fact that there could be ups and downs in markets, then please by all means invest one shot. But be also ready for the fact that there is volatility that is inherent to investing. But in case you want to stick to the fact that you will never deviate from the fact that your goal is critical, then the SIP route becomes supremely important. And which is why I keep coming back to the word goal. In fact, I would even go one step ahead. I won't even call it a goal. You must invest for your dreams, because dreams is something that is that's core to your heart. It's emotional. It drives people to do, to kind of come to work every day, do what you do. And as long as you get it right for your dreams and goals, this form of investing will help you reach your dreams.
So there is another question. It's related to this. Given the market valuations are high, is it prudent to start SIPs right now, or should we wait for the market to correct? I think it's more to the term of how long they should invest.
So two questions have destroyed more wealth than have created wealth. The first question that has actually destroyed more wealth is market kya lag raha hai? What is the market looking like? That question has actually destroyed more wealth than the market itself. The second question that has actually destroyed more wealth is more wealth has been destroyed waiting for corrections than investing. It never works. So I've been asked this question when the markets were 9,000, 15,000, 18,000, 20,000, 24,000, 26,000, 30,000, 34,000. And at every point in time, my answer is the same. Markets will do what they have to. You need to do what you have to. Please understand the fundamental question that it's all about yourself and your dreams and your goals. You've got to understand this fundamental reason for investing. As long as you know why you are investing, the markets actually then become meaningless. Because what you're saying is you're taking a 10-year view, you're taking a 15-year view, and you're taking an 18-year view, or sometimes even taking a 5-year view. And over those frames of time, the markets have always delivered. The intermittent volatility has been always the problem to deal with, and hence this way of coming in monthly and kind of riding the volatility. So to your question, my straight answer is please never ever focus on the fact that whether the markets are correct, incorrect, highly valued, not valued, because that's the nature of the markets. We have to do what is correct for us, which is figure out why we are investing, reach out to our advisors, and then start investing. And you must ask the question, when do you need to disinvest? So please disinvest when your goal has got achieved. As simple as that.
That's coming. So question is related to that on STP. So if we opt for STP, can we increase it in later stages? How do we do it that first? Where do we do a stop visit after 3 years, 4 years, 5 years? When and how much amount you need to take out of the STP route?
So what I'll do is answer this question in a way of when to stop an SIP and when is it that you need to disinvest.
Yeah, exactly.
So actually, there have been cases when in my own firm, we've actually signed for perpetual SIPs, meaning they continue forever till the time you actually need the money. And perpetual SIP can go on for 99 years. That's not what I'm suggesting. The moot point, what I'm suggesting is the end of the SIP, the end of the STP, and the end of this transaction comes when it's closer to your goal. Again, let me give you an example. I plan to retire much ahead of the typical age of 60, and so technically that's not too far out. So it's not like 15 years away, or it could literally be, let's say, 5 years away. So for me, if I was to start an SIP today, it would end on the year I need my corpus for retirement. So it's 5 years away, literally 5 years away. And whether it's the STP route or the SIP route, I will stop the transaction on the 5th year. But the difference is my amounts would have to be much, much higher per month. Or for that matter, my systematic transfer plans will have to be much higher to reach to that corpus. That's the difference. So taking money off the table is solely, wholly, and totally in your control, and it has to be dominated by what your goals and dreams are. You cannot leave it to the whims and fancies of the markets, because the markets you have to assume that the markets will always behave contrary to your expectations. So the day you invest, the markets will fall. If you can build that thought process in your mind and then invest, you will create wealth.
So this is more pointed question. So what is your recommendation for a portfolio mix for a newly married couple planning to start a family?
Okay, first of all, congratulations. Well done. So for a newly married couple, and first things first, it's very important that the husband and wife both understand that this is almost like marriage. You cannot move out of your investments just because the markets are volatile. So my fundamental advice to all of you, or the couple that is on this call, is you have to help each other out when the markets are not in your favor. And don't get very edgy if the markets fall. And if you all are investing for your own retirements or for a corpus which is, let's say, for a family, I would seriously suggest you all to take a 25-year view. 25 years. So I'm assuming you all are anything between 25 and 30. If that's your age, if you were to take a 20-year view, you're actually saying by the time you're 45 and 50, that's the kind of corpus you want to create. Can you imagine the power of compounding for this couple if you all were to take a 20-year view and stick to that magic of investing per month? You would well and truly retire at least 15 years ahead of everyone else who are your friends.
So next is it important to rebalance your SIP portfolio periodically, or can one simply continue investing in the belief that long-term will outperform?
So one of the things that one of the places where SIPs falter is when we look at SIPs and think that it's for small amounts. That's not necessarily true. It is actually meant for your goal, and hence the SIP value should be, commensurate with the goal itself. And let's assume you start off with whatever amount, 10,000 or 15,000, but actually the goal requires you to invest 30,000 per month, you would need to top it up. There's no doubt about it. Or you'll have to extend it by another 5 years, whichever way you look at it. So I would always suggest that as a thumb rule, 30% of all earnings should, on a monthly basis, 30-35% net of taxes, should get invested in an SIP or an SWP or in some form of investment. 30-35% must go post-tax. That is, post-tax your liquidity. 30-35% must go into some form of investment.
So this question is on like ELSs or lock-in funds. What is the ideal period, and should an SIP route use for this?
That's a good question. At Axis, we have the largest ELSS fund in the country, and it's a very successful fund. One of the reasons why it became successful is because there was a forced investment of 3 years, or at least staying put for 3 years. It really helped the fund managers. In our case, it really helped the fund managers to take a slightly longer term view. Now, the reason why I say that is because in India, the holding period is just 18 months. It's going to get no one to make money. I mean, 18 months to 24 months, you're really not going to get a benefit of what capital markets are all about. So, yes, ELSS funds or some of these locked-in funds gave the advantage to the fund manager to take a slightly longer term view. I would think that it's kind of, you could put that discipline in yourself and say that why 3, why not 30? As long as the discipline is maintained and that it will deliver, it would help. Having said that, these locked-in funds have been able to kind of allow the fund manager to take slightly longer term calls because they knew that the money was there for a longer period.
What, in your view, is the 3, 5, 7-year expectation from the Indian market? What sectors you pick? And do you recommend investing a bit directly, or would you recommend the SIP route is the best way?
So a lot of questions in this particular set. I'll start with the last question first. The question about investing directly versus, I would never ever recommend going direct because remember, I don't know what you do. So let's just assume that you're a professional. You're probably the CEO of a firm, or you run a business, or you're a doctor. That's your profession. And capital markets is a full-time job. It requires intense study. It can take away a lot of your time, and I would always recommend and suggest an advisor to be associated with you, and in this case Standard Chartered is always there, because remember, what people tend to forget is it's very easy to come and invest directly, but it's very tough when the markets are not conducive, when the markets are not behaving as to what you expected them to. At that time, you don't need a fund manager. At that time, you need an emotional manager. People who will help you right through the volatility. And that time, direct does not help. So that's my first suggestion. Always look out for a partner who will actually tide through tough times. On your question of sectors, like I said, India has 32 sectors to offer. But it's very important. So the way we build our portfolios at Axis is what we avoid. So there are sectors that we tend to avoid. There are sectors that we tend not to invest too much in. For example, in our own portfolios, we've not really taken exposure to PSU banks. We've not been very exposed to infrastructure or real estate, for that matter. We don't take exposure to cyclical stocks, to commodity stocks. So those are sectors that we don't do. Hence, whatever is left, we do. For example, consumer, we do auto ancillary, we do private banks, we do non-banking finance companies. Those are sectors that we are very excited about, paints, etc. So if you notice, making money is not just about what you do. It's also about what you don't do. And in our case, there are these sectors that we don't do, which I just explained to you. On your last question about 3, 5, and 7-year returns, 3 and 5, in my opinion, as I defined it, is short term. I would never hazard a guess on what equities can offer over 5 years, because that, to my mind, is slightly too short a period. But over 7 and 10 years, like I mentioned, if equities were to deliver anything between 11 and 14% compounded, I think that's a great way to create wealth. I don't know if Vinay you agree on that number, but equities that is the right number is around 12 to 14%.
Yeah, 12 to 14% is roughly how much you get the average returns. And as you have mentioned, mutual funds generally give about a 3 to 4% extra return on that. So
I'm being conservative over here. So the markets deliver anything 12 to 14%, and if StanChart chooses their funds correctly, you can always add 400 basis, 300 basis points to that.
This is quite a nice question. So the gentleman is 27 years old, going to get married in a year, and would like to buy a house in 4-5 years. He has no knowledge of SIP, fund, shares, etc. So he's basically asking what kind of investment he should do, how he should invest in, so that he has after 4-5 years some money left for the down payment of his house.
I'm just so reminded of my own time, because this is like almost a walk back in history So at 27, if you don't know anything about capital markets or equities or SIPs and investments, great. That's a great starting point, because that sometimes too much knowledge and too much exposure actually allows us to overthink and to kind of expect the markets to work in our favor. My simple, humble advice to you is, if you want a house over the next, from the time that you start, and if you take a 10-year view or an 8-year view, invest in couple of maximum 2 to 3 equity funds based on recommendations from StanChart. Look at 2 or 3 equity funds and make sure that you do not disinvest come what may. And as long as you can stick to that discipline and the rigor of investing, your house will be made.
The next question is on what if an SIP is not performing well? Should we withdraw money, stop investing in that fund, and what time horizon should we see when we should check the fund performance and see them?
I think that's a great question, because sometimes it's not just about fill it, shut it, forget it. That's a great question. There have been there have been funds which have under-delivered as well, and I think that's where StanChart teams kind of step in and they kind of recommend the funds. I would think if you started an SIP, at least a 3-year horizon is the right horizon for us to have some track record on performance. Because remember, you need at least 3 to 4 years to figure out how over a cycle how that SIP is performed. But if it is not performing, please reach out to your advisors and to your relationship managers and ask them for the reasons. So do not disinvest from the SIP culture. Disinvest from the scheme. I think that's really, but give it at least 3 to 4 years, because you've got to give the fund managers at least one cycle to see how they perform.
How many SIPs are actually advisable, you would see, and how many would you see SIPs, and should you start topping up during when the markets are down? So it's come to a question of, should the SIP used as a market timing tool, which I don't think is.
So how many SIPs? 3. That's it. Not more than 3. And those 3 also should be completely 3 different styles of investing. So just don't pick up 3 schemes who pretty much have the same style of investing. So if one of them has Infosys as a top pick, the other has Infosys as a second pick, and the third one has Infosys as amongst the top picks, you're literally buying more Infosys and not 3 schemes. So my recommendation would always be buy 2 to 3 SIPs, but make sure that the styles of investing in the 3 different schemes is completely different to each other. That's true diversification. So one scheme is actually giving you HDFC, one is giving you Infosys, and the other is giving you Maruti. In that format. So what I'm really saying is stock diversification is very critical and not scheme diversification. 3 is a great number to start with. You don't want to complicate things with 7 and 8 and 9. It never works. It never pays off. 2 to 3 schemes is good enough as long as the schemes are diversified. So you could actually look at that someone who's focused on growth, someone who's focused on value, and someone who's kind of taking a multi-cap view to investing. So there are ways to format that together. And again, you should always reach out to the team at StanChart. They can easily help you pick up 3 schemes that mirror each other and actually are complementary to each other and not necessarily similar.
So this is a question, if you have 10,000 rupees, I think it's basically how much ever money you have. If you want to invest, suppose 10,000 or 15,000 in a month, should you start SIP only in one fund or should you split it in 3, 4? And what's the ideal mix? How much you should? I think you've answered partly that.
So two schemes, 2 is ideal. As long as the 2 are very different from each other, you get true diversification. I think 2 or 3 is perfect to start with. And remember, so you could start with 1 as well. There are 2 reasons why you're investing. You're investing to ride through the volatility that markets offer and to create wealth. And the reason for diversifying into 2 or 3 schemes is to get maximum exposure to different stocks. I think that's the reason for the diversification. Otherwise, even 1 is good enough. But over diversification can be a killer. I would never ever recommend 5, 7, and 8 schemes because then you're buying the same stocks in different funds. It makes no sense.
So this is, I think, basically on top-ups for SIP. Suppose you have an extra amount in a particular month. Will it help in investing in the ongoing SIP itself?
Oh, absolutely. Absolutely. Never ever. If it's working well for you, the numbers are good, and if you're comfortable, if you like the stocks that are there, and it's on the recommendation of StanChart, just do a top-up. That makes tremendous sense. There's no point, And remember, at the end of it, we're trying to decomplicate life. Anyway, life can be very, very complex. You don't want to add more complexity by having another, fund just because you've got extra money. Topping it up. But the fundamental premise in all of this is it should match with the philosophy of why you're investing, and it should intuitively make sense as to what the fund manager is up to. I think those 2 things are really critical, and you'll see that in portfolios So one of the things I would recommend to everyone on this call is once in a while pick up the fact sheet of a fund that you've invested in and just look at the top 10 stocks. Intuitively, if those stocks make sense to you and if you're comfortable, then you'll know whether you're on the right path or not. Always just have a look at what the stocks that you hold are all about. That would help.
Yeah, so there's a question on about index funds and exchange traded funds. Are these also, should we use this as a diversification basket for large cap funds?
So a lot, of course, this in the West, indexation and low cost funds have become the rage. In fact, they're actually getting disproportionate share. But that's the story for the West, where they have an 80, 90-year track record on mutual funds. We are a very nascent country. Our track record on mutual funds is about 20, 25 years. And then, more importantly, fund managers have always added alpha and they've always added value when it's come to investing. So, fundamentally, I do believe that over the next 10 years, fund managers in India will always add value. And anything between 2% to 3% is the number that I think fund managers will still add value to. And I think if you can take a 10-year view, then rather be with an active manager. Because there is potential for managers to add value. Or after 10 years from now, when it's going to get competitive, extremely tough, when data flows are so much more, when data flows don't allow you to kind of take decisions ahead of time, that's when maybe value and indexing, or for that matter, low-cost investing will become very prominent. That will become prominent, as has become prominent in any part of the world, but we still some time away.
So you had mentioned about perpetual SIPs, so there were some questions on that. Are they good for investing, and what time horizon should you see, and how you track them?
So by perpetual SIP, what I meant is that don't take a view on when to stop. You actually sign up for 99 years. And obviously, you can stop when you want to. the intent of that perpetual SIP is that you continue investing till you think that you've reached the reason why you invested. Even before you start all of this, whether it's perpetual, 9 days, 9 months, 99 years, it doesn't matter. What matters is why did you start in the first place? As simple as that. Well, you could do an SIP for as short as 2 years, because that can be in a bond fund or it can be in a short-term fund, simply because you're investing because you want the money back in 2 years. As simple as that. So my sincere advice to everyone on this call is, please ask the fundamental question to yourself: why are you investing? And if the answer is simply to make money, that's great. But always remember, in that case, short term is 5 years, medium term is 8 years, and long term is 10 to 15 years.
So, shortage of time, so maybe one last question we'll take, and then you could quickly summarize 3 benefits which you would see of SIP. So the last question is liquid funds. So what is a good option for? Mostly you use it for spare money after monthly expenses. So is SIP also a good route for liquid funds?
Yes and no. Yes and no, because remember, liquid funds is a parking avenue. It's not an investing avenue. So I would always recommend using the liquid funds for immediate liquidity, single day liquidity, 5-day liquidity, 10-day liquidity, 20-day liquidity. So by definition, liquid funds are for your overnight use, for use which is in less than 30 days, 40 days, 50 days. But if you're taking an SIP, I would always recommend an asset allocation fund or an equity fund, or for that matter, a bond fund. See, the reason why I say that is, if you're willing to commit to an SIP over longer frames of time, then you would rather be exposed to capital markets. Liquid funds won't necessarily generate that kind of wealth or returns, especially if you're taking a longer term call. Always use liquid funds for your 30-day liquidity.
So, Karan, thanks a lot for joining. So, could you, in just few lines, sum up why SIP is a good investment tool for wealth, and how should an investor position themselves?
So, so for just very, very quickly, and I can just sum this up. SIPs in India are becoming the new world of investing. So they are going to replace the word RD and FD, and you can see that trend over the next 5 and 7 years. The simple fact of the matter is that they give you exposure to equities, to capital markets, or to bond markets, and yet they stagger out the volatility. And I think that's really, really critical. So whether the markets are down or they're kind of moving up, it doesn't matter to you, because what you're doing is you are investing on a certain time frame. And third, and perhaps the most important fact, which is now mathematically proven, that in India there are funds, there are schemes that have generated 20% CAGR over 20 years. That's perhaps the best that the world can ever offer. And if you can take those kind of time horizons, be very sure why you're investing, this country will create wealth for you. Most importantly, please reach out to advisors and relationship managers. Doing it yourself can sometimes be a bit dangerous too.
So, thanks, Karan. Our customers, we would like to thank you that you all dialed in for this webinar. Please update your CIP and give a call back consent on the survey form, so that if in case you feel your questions have been answered, we'll get back to you. Just before we wrap up, I would like to say that SIPs is a very key investment tool for building wealth, as highlighted by Karan, and seeing the inflow of questions. We really have a very active participation in this. 6 points which we would like to highlight on the SIP route. We think that through SIPs you get a lot of discipline in market. It's very important that you have discipline while investing. The other thing also, which Karan alluded to, you get a lot of rupee cost averaging through SIPs, so you don't have to time the market. The biggest benefit through SIPs is the power of compounding, which we feel, as Karan said, long-term returns. If you go in 15 years, the power of compounding is just huge. Putting 5,000 per month in 10 years, you would have invested 12 lakhs at a 12% to 13% annualized return. You would end up, or CAGR, you would end up getting nearly 30 lakhs. So you nearly triple your money. So that's the power of compounding, and that's what SIPs does. It also helps you not to time the market. It's a very flexible tool which helps to increase or decrease your according to your needs. And the most important thing, it helps achieving your financial goals. So with that, I would like to again thank Karan and all the attendees here. And please sign your, give your feedback through the CIP form and the survey form. Thank you all for joining in.
Thank you.
And
thank you for being patient listeners.
Yes, patient listeners also. Thank you all.
Thank you.